Hello, everybody. My name is Aaron Clary, and this is Retirement Planning in Under 10 Minutes. I put together this video because what I've noticed through clients and students, most people are intimidated by retirement planning, and retirement planning is seemingly so complex that it actually scares people into inaction to the point that they never do any retirement planning whatsoever. It's not that they can't afford it. It's not that they don't want to do it. It's just that the time it takes to study up on it and figure out what you're doing scares people away to the point they don't do anything. So operating from the premise that at least some modicum of retirement planning is better than none, I've put together this very short, very succinct, and very efficient how to retire in 10 minutes. It is not perfectly optimized. There are going to be errors and mistakes for everyone, but once again, it operates from the premise that this is better than doing nothing. So if you want, you can study more. I have some classes I'll link down to below if you're interested in doing more. But this is the quick fix for a problem that many Americans have. Right? First thing, step one, you have to figure out how much you need. Now you could do this there are many different online calculators. I prefer Bankrate, and I have them bookmarked here. There are many different retirement calculators that Bankrate has, and you're going to want to go to how much to retire. You see here, you enter in these 5 numbers, all of which are going to be wrong, but it's better to do something than nothing. So the annual income required in today's dollars, I'm going to say $25,000. Number of years until retirement, for me that's 25. Number of years required after retirement, I'm going to say another 25. You always want to overestimate your life expectancy. Average annual rate of inflation, I'm going to go 2.5%. Average yield on balance, I'm going to leave that 7.5%. Again, these are all wrong, but it's going to give you something to work with. We hit calculate, and it pulls up our results there, and we scroll down, and right here, I need $693,000, which is called $694,000. Now, how much is that per month? Well, there's another retirement calculator that Bankrate has, and you go and says, how do I reach my retirement goal? So I'll put these links in down below. But how much do I need to retire? I need $694,000. I'm going to hit next. How many years until I retire? 25 again. Kind of entering some of the same data. What is the current value of my retirement investments? Let's just say $150,000. Don't forget the value of your house, guys. That's another thing. Don't forget the value of your house. You're going to use that during retirement. Are you expecting any windfalls or inheritance? No, because my parents are piss poor. And here it is. To reach your retirement goal, you must save approximately $7,500 each year. And then they give you the monthly amount right there. $616 per month. Right? Now, step 3. All right, you got to find a retirement plan. And here we have a couple options, namely 2, and it depends on whether or not your employer offers you a retirement plan. If your employer does offer you a retirement plan, it is going to be named something like the 401k, a 403b, a 457. There's some other forms, especially for those of you in the military. But largely, it's the 4Os that is the employer-sponsored retirement plan. To enroll in that, you simply go and talk to your HR representative or your boss. They'll give you some kind of training. They'll introduce you to it. It'll all be very boring, but they will at least set you up with a retirement plan. If you do not have a retirement plan offered by your employer, then you have to go and get one yourself. And that is where this thing called the Individual Retirement Account, or the IRA, comes in. So you will go to a bank or a brokerage of your choosing, or some financial institution. Many of them offer IRA-type brokerage accounts. And you'll sign up with them. You'll fund it, and then you can go ahead and make your investments there. Now, when it comes to choosing your IRA account, choosing a brokerage, or choosing a bank, there are 2 things you want to look for. One, you want what's called a self-directed plan. That means you can invest in whatever you want. A lot of the IRAs offered by banks and brokerages already have an agreement with the mutual fund company that has swooned and wined and dined the managers of that bank or brokerage to offer exclusively their retirement plans or their mutual funds, or Fidelity or Vanguard or whatever else. You want to be able to invest in whatever you want to. Okay, so that has to be self-directed. And then secondly, you want to make sure that you can trade in pretty much everything, not just mutual funds. You want to be able to invest in stocks, bonds, mutual funds, ETFs called exchange traded funds, and real estate investment trusts. If they don't have real estate investment trusts, that's all right, but you prefer to have that option. And this will allow you to invest into the various asset classes. They'll allow you to have a very diversified portfolio. Now, once you have set that up, you found yourself either an online brokerage or you have a retirement plan set up through your employer. The next thing you have to do is determine what type of retirement account do you want. There are two options for both the 401ks, 403bs, 457s, and the IRAs. There are Roth and traditional. The traditional retirement plans means that your investments, whatever your contributions into this retirement account, are tax deductible from that year's taxes. Now, this is the incentive that the government gave people to retire, so you get a tax deduction. So you throw your $3,000 or $4,000 or $5,000 into a retirement account, you get to write that off of your taxes, you get some tax savings. The other one is a Roth. The Roth, you do not get a tax deduction, but your investments grow tax-free. So when you withdraw them down the road, you will not pay taxes on them like you do a traditional IRA or 401k. The general rule of thumb is that if you're young, you want a Roth IRA because you have more time for your investments to grow. If you're older, you want to go with a traditional IRA because you don't have that much time for them to grow, and you're probably in your upper income earning years. And yes, you may have both a Roth and a traditional, but your contributions may not totally exceed each year's annual limit, which is explained in the IRS every year. There is no right or wrong as to what age you should go Roth versus traditional, but I'm going to give the general and completely wrong rule of thumb that if you're 45 and younger, you go with a Roth, and if you're 46 and older, you go with a traditional IRA. The final step is now you have to choose your investments. And the general rule of thumb is once again kind of along the Roth IRA, traditional IRA. Are you younger? Are you older? The younger you are, the more risk you can afford because stocks and bonds will go up and down, but over the long time, they have a tendency to go up. So you invest in riskier assets such as stocks, not just stocks, but international stocks, foreign stocks, aggressive growth, micro cap, startups, stuff like that. If you're middle-aged, well, then you're starting to look at standard blue chip stocks, reliable stocks, and you're also starting to look at some, maybe some risky bonds or some higher, some higher returning bonds. And then if you're old, you're starting to look primarily at bonds, safe investments, probably your government bonds, high-quality corporate bonds. You still have some stocks, but you're not out there gambling in Vegas to make that quick killing. Now, what percentage is that and where? It all depends on your age and, more important, life expectancy, which many people are not accounting for. The quick and dirty way to do this is to look up target date funds. You say, what's a target date funds? Well, they are called like Vanguard's 2035. You say, well, what's 2035 for? That is the date that you would target to retire on. So if your retirement falls close to 2035, you would invest in the Fidelity or the Vanguard 2035 fund. And as you age, that mutual fund company maneuvers and adjusts their investments to replicate or optimize an investment portfolio that is best for a person that age. So it takes very little time, if anything, the least amount of time, because it requires no management on your part. So that's the quick and dirty way of doing it. If you want another way to do it, you can invest in index funds, or what also called ETFs, even though they're not technically one and the same. And investing in index funds or ETFs, you're going to beat the majority of investment professionals. I won't go into the details why. You're just going to have to trust me because that's what it historically has been. So you find out what the allocations are between stocks, bonds, international, etc. in these target date funds, and you merely go and invest in the indexed or ETF funds that track those different stock and bond categories. That's going to take a little bit more research, but it's doable. Finally, if you think you can beat the professionals and you have more time to adequately research your investments, go to Morningstar.com. You go there, they have a star rating from 0 to 5 stars. Obviously, you want the 5-star funds that fit the category that also mimics those target date fund allocations. But you may also want to focus in on a beta, which is a measure of risk. And you also want to make sure that those funds historically beat the index. You will see a chart there that shows the mutual fund versus the S&P 500, which is not the index you want to compare it against, versus its respective fund, the fund that more represents the true index and the underlying investments in that mutual fund. Still, the cheap and easy way out, the quick and dirty way, is just those target date funds. Okay. Now, there is no guarantee in the future that the government won't confiscate your retirement funds anyway. It's happened in Argentina, Bulgaria, and Poland. There's no guarantee the stock market ain't going to crash. There's no guarantee. There's all this other stuff going on. But this gives you a very simple and quick and dirty roadmap towards retirement planning. And it won't guarantee anything. It'll probably be wrong, and definitely you might want to research and study up a little bit more on how to retire. But if you at least start now and do this, it is going to save you an immeasurable amount of pain and agony and perhaps even poverty when you're older and you're maybe even incapacitated and can't work. You can visit my other sites and get some super awesome economic genius. Go to captaincapitalism.blogspot.com. I have a YouTube channel. Just search Aaron Clarey, not Cleary, Clarey, Clarey. I have a podcast called The Clarey Podcast. I also have a consulting division called Asshole Consulting. I apologize for the language, but we specialize in blunt, direct truth, and we don't care about people's feelings. You may also be curious about my books, Bachelor Pad Economics, Worthless, Enjoy the Decline, Black Man's Guide Out of Poverty, and Captain Capitalism Top Shelf. Those can all be found on Amazon. And most importantly for you guys, I have 2 online classes you may be interested in that focus on investing and retiring. One is called The Analysis and Valuation of Stocks. The other one is called Stocks, Bonds, Investing, Oh My. That is more the introductory course that I think might suit most people's needs as it is right now, especially if you're looking to get into investing. Links will be put below, and I thank you for your time. Toodles.